I need to tell you about something that should fundamentally change how you think about every dollar you own. The Federal Reserve, the institution I have watched manage the world's reserve currency for 5 decades, is running an accumulated loss of $245 billion on its balance sheet. Not a projected loss, not a theoretical accounting concern, an actual realized $250 billion hole that grows larger every single quarter. And here is what makes this different from every other central bank crisis I have studied in 50 years of analyzing monetary systems. The Fed has created a new accounting category to hide this loss from public attention. They call it a deferred asset. Let me translate that term into plain language. The Federal Reserve is insolvent by any private sector accounting standard, and they have simply renamed insolvency to make it disappear from the headlines. This is not a technical accounting debate. This is the mechanical breakdown of the institution that backs every dollar in your savings account, every treasury bond in your retirement portfolio, every money market fund you think is safe. When a central bank cannot earn more on its assets than it pays on its liabilities, the currency it issues is being debased in real time, whether or not they announce it in a press conference. Subscribe now, because what I am about to explain is not a prediction about what might happen. It is a diagnosis of what is already happening to the purchasing power of your wealth, and why the investors who understand central bank insolvency are quietly repositioning before this becomes a mainstream crisis. Here is how the Fed arrived at a $245 billion loss. In March 2020, facing the economic shutdown from COVID, the Federal Reserve launched the largest monetary expansion in American history. They created $4.8 trillion in new money through quantitative easing. They used that money to purchase treasury bonds and mortgage-backed securities with the explicit goal of suppressing interest rates to zero and flooding the financial system with liquidity. The bonds they purchased were yielding between 1.5 and 2.5%. That was the market rate when the Fed was actively buying and rates were at historic lows. Those purchases are now assets on the Fed's balance sheet. They sit there generating 1.5 to 2.5% annual returns. Here is the problem. Today, the Federal Reserve is paying 3.65% interest on reserve balances. That is the rate the Fed must pay to banks to keep their reserves parked at the central bank rather than flooding into the economy and causing runaway inflation. The gap between what the Fed earns on its assets, 1.5 to 2.5%, and what it pays on its liabilities, 3.65%, is the loss. And that loss compounds daily. This is not a hedge fund taking speculative risk. This is not a regional bank making bad loans. This is the central bank of the United States running the most basic banking operation imaginable. Borrow low and lend high, except they are doing it backwards. They are borrowing high and lending low. And the cumulative result, after 3 years of this inverted spread, is $245 billion in losses. In 50 years of studying how central banks navigate debt cycles, I have learned that the losses themselves are not the crisis. The crisis is what the losses force the central bank to do next, and the Fed's options are narrowing with every passing quarter. Here is the mechanism that connects the Fed's loss to your personal wealth. The Federal Reserve is structured to return its profits to the U.S. Treasury. In normal years, the Fed earns interest on its bond holdings, covers its operating expenses, and remits the remainder, typically $80 to $100 billion per year, to the Treasury as revenue. That revenue helps fund the federal government and reduces the deficit. Since 2022, those remittances have stopped. The Fed is not generating profits. It is generating losses. The Treasury is not receiving $80 to $100 billion per year. The deficit is wider by exactly that amount. And the federal government must borrow more to cover the shortfall, which increases the national debt, which increases the interest burden, which makes the fiscal situation more fragile. This is the feedback loop that I have watched destroy currencies in every debt cycle crisis I have studied. The central bank takes losses to stabilize the system. The losses prevent the central bank from supporting the Treasury. The Treasury must borrow more. The increased borrowing makes the central bank's job harder. The cycle accelerates until something breaks. Here is the timeline. The Fed's deferred asset, the accounting term for its accumulated losses, is currently $245 billion. It is growing at approximately $25 billion per quarter. At that pace, the deferred asset will reach $300 billion by mid-2027. When it crosses $300 billion, the political and media pressure to address it becomes unavoidable. The Fed will face a choice. Option one, continue running losses indefinitely and hope the economy grows fast enough and interest rates fall fast enough to close the gap between what they earn and what they pay. That is the path of least resistance, but it is also the path that leads to larger losses if rates stay elevated or rise further. Option two, sell the bonds they purchased at 1.5% yields and replace them with bonds yielding 4.25%. That would close the income gap, but it would also crystallize massive losses because bonds purchased at 1.5% are worth significantly less than par value when new bonds yield 4.25%. Selling those bonds would immediately wipe out the Fed's capital and force an explicit admission of insolvency. Option three, print money to cover the losses. The Fed could expand its balance sheet, create new reserves, and use those reserves to pay the interest on existing reserves. This is monetary debasement disguised as liability management. It is not technically called quantitative easing, but the effect is identical. The money supply increases, the currency is debased, and inflation accelerates. Here is what I have observed in 50 years. Central banks always choose option three. They do not announce it as policy. They do not hold press conferences explaining that they are printing money to cover insolvency. They implement it quietly under technical names like reserve management purchases or liquidity operations or temporary facilities. And by the time the market realizes what is happening, the currency debasement is already priced into real assets. That is happening right now. In December 2025, the Federal Reserve quietly began a program called Reserve Management Purchases. The stated purpose is to manage reserve levels in the banking system. The actual function is to create $40 billion per month in new reserves to purchase short-term Treasury securities. $40 billion per month is $480 billion annually. That is not a reserve management operation. That is quantitative easing under a different name. The Fed is running a $245 billion loss, paying higher rates than it earns, and simultaneously creating $40 billion per month in new money. These are not separate events. They are connected mechanics of the same process. The Fed is insolvent, cannot stop paying high rates without triggering inflation, and is covering the gap with money creation. Here is what this means for your savings. If you hold cash, money market funds, or short-term treasury bills, you are holding an asset denominated in a currency issued by an insolvent central bank that is printing money to cover its losses. The nominal value of your savings will not change. The number in your account will stay the same, but the purchasing power of that number is declining in real time as the Fed creates new dollars to fund its own operations. This is not inflation in the traditional sense. Traditional inflation is caused by supply shocks or demand surges in the real economy. This is monetary debasement. It is caused by the central bank creating more currency units than the productive economy can absorb without price increases. And it happens whether or not the consumer price index reflects it immediately, because currency debasement operates on the supply side of money, not the demand side of goods. I have watched this pattern unfold in every major currency crisis of the last 50 years. The Weimar Republic in the 1920s, the Latin American debt crises in the 1980s, the Asian financial crisis in 1997, the Turkish lira, the Argentine peso, the Venezuelan bolivar. Every case followed the same sequence. The central bank takes losses. The government cannot fund itself. The central bank prints money to cover the gap. The currency loses purchasing power, and the wealth holders who did not reposition into real assets watch their savings evaporate in real terms. The United States is not Zimbabwe. The dollar is not the bolivar. But the mechanics of central bank insolvency are universal, and the Federal Reserve right now is running those mechanics in slow motion. Here is what I am watching to gauge when the slow motion accelerates. First, the deferred asset line item on the Fed's balance sheet. It is published quarterly in the Fed's H.4.1 statistical release. When it crosses $300 billion, the political pressure to address it becomes acute. That threshold is likely to be crossed by late 2026 or early 2027 based on the current rate of loss accumulation. Second, the Fed's reserve management purchases. The program is currently running at $40 billion per month. If that number increases to 60 or 80 billion per month, it signals the Fed is accelerating money creation to cover widening losses. That acceleration is the tell that the Fed has moved from managing the problem to financing the problem. Third, the 10-year Treasury yield. It is currently at 4.25%. If the yield stays elevated above 4%, the Fed's losses continue to compound because the gap between what it earns and what it pays remains wide. If the yield falls below 3.5%, it signals the market expects the Fed to cut rates or the economy to weaken significantly, both of which make the debt situation worse in different ways. These three indicators, the deferred asset, the reserve creation rate, and the 10-year yield, are the early warning system for when the Fed's insolvency transitions from a hidden accounting problem to a visible currency crisis. Here is what I am doing with my own capital based on this analysis. I am reducing exposure to long-duration dollar-denominated assets. That means selling 30-year Treasury bonds, reducing holdings in dollar-based money market funds, and avoiding any asset whose return depends on the dollar maintaining its current purchasing power over the next decade. I am increasing exposure to real assets with no counterparty risk. Gold is the most liquid and historically proven form of that trade. It cannot be printed, it cannot be frozen, it cannot default. It simply reprices to reflect the supply of currency in the system. Central banks understand this, which is why they purchased 863 tons of gold in 2025, continuing a 3-year trend of buying at double the historical average. I'm also positioning in productive real assets, farmland, energy infrastructure, businesses with pricing power that can pass cost increases through to customers. These assets generate returns in nominal currency terms, but their real value comes from their ability to produce goods and services that people need regardless of what happens to the currency. And critically, I am avoiding the mistake that most investors make in every currency debasement cycle I have studied. They wait for confirmation. They wait for the Fed to announce that they are printing money to cover losses. They wait for the media to report that the dollar is in crisis. They wait for the academic papers to confirm that central bank insolvency leads to currency debasement. By the time that confirmation arrives, the repositioning opportunity is gone. The assets that protect against debasement, gold, real estate, productive businesses have already repriced higher. The investors who waited for confirmation are buying at the top of the defensive move, not the bottom. The confirmation you are waiting for is already here. It is published in the Fed's quarterly balance sheet. It is visible in the $40 billion per month reserve creation program. It is reflected in the 3 consecutive years of central bank gold purchases at double the historical rate. The data is public. The mechanism is clear. The only question is whether you act on it before the narrative catches up to the numbers. I want to be direct about what I am not saying. I am not saying the dollar will collapse tomorrow. I am not saying you should sell every dollar-denominated asset you own and move to a bunker with gold bars. I am saying that the Federal Reserve is running a $245 billion loss, that the loss is structural rather than temporary, and that the mechanics of how central banks resolve structural losses are predictable based on 50 years of historical precedent. Central banks do not admit insolvency. They monetize it. They print money, call it something technical, and hope the economy grows fast enough to outrun the debasement. Sometimes it works, often it does not, and the investors who understand the difference between what central banks say and what central banks do are the ones who preserve wealth through the transition. The Fed's $245 billion loss is not a secret. It is public information. It is reported every quarter. It is discussed in academic papers and financial blogs, but it is reported in language designed to minimize alarm, buried in technical accounting terms, and framed as a temporary mismatch rather than a structural insolvency. Your job as an investor is to read past the language and understand the mechanics. The Fed is paying more than it earns. The gap is widening. The losses are compounding. And the only tool the Fed has to resolve it without crashing the economy or admitting insolvency is to create new money. That money creation debases every dollar in existence, including the dollars in your savings account. In 50 years of studying debt cycles, I have learned that the investors who preserve wealth through currency transitions are not the ones with the best forecasts. They are the ones who understand the mechanics, recognize the pattern, and reposition before the transition becomes obvious. The mechanics are clear, the pattern is repeating. And the transition, whether it takes 2 years or 10, is already in motion. Subscribe now because the $245 billion loss is not the story. The story is what the Fed does next to cover it. And the investors who understand what central banks always do next are the ones who will look back at this moment and realize it was not a crisis. It was an opportunity to reposition wealth before the rest of the market understood what was happening. The numbers are public. The mechanics are predictable. The question is whether you act on the information before the narrative makes it obvious to everyone else.